Corporate Finance, Core, Topic 7, Cost of Capital. Learning Objective number 6. I want to understand optimal capital structure and how it relates to WACC. So the concept of optimal capital structure is that mix of debt and equity instruments that minimizes the cost of capital, or WACC. It's also equivalent to maximizing equity value. Remember, when you value a firm, it's the present value of free cash flows discounted at WACC. So if you can reduce the WACC, you can increase the value of the firm. So the question is, what is that mix of debt versus equity, optimal DE ratio? And also, if you have debt, what is the optimal mix of short-term debt versus long-term debt? Or say for equity, preferred stock versus common stock. So this is the concept of optimal capital structure, how much debt to use and which type of debt or equity instruments. So let's talk about equity versus debt advantages and disadvantages. So what are the advantages of using equity to finance a project? Well, or a firm in general. Well, if you use equity, you're going to have higher net income because you have no interest expense. You're also going to have lower financial risk. If you use equity, you're going to have no risk of bankruptcy and related distress costs. So you don't actually have to go bankrupt to have distress costs. People feel you're going to go bankrupt and maybe you lose some employees or lose some key customers. Also, if you use equity and choose not to use debt, you're preserving debt capacity for future investments. The idea here is at some point, companies may have an extraordinary opportunity, but if they've already used a lot of debt, they may go to the banks or to the bondholders, and they're just not willing to lend anymore. So the idea that if you don't borrow now, you can always borrow later, and you might have something really cool you want to buy or valuable. So what are the disadvantages of debt? Well, ownership is diluted. So the more owners you have, the less voting right that you have as a share, and also you're going to get smaller and smaller dividends. Also, if you issue more stock, it's sometimes viewed as a signal that the managers feel the stock is overvalued. So why would a company issue stock if they think their stock is really undervalued? Well, they probably wouldn't. If they really feel their stock is undervalued, why sell it now? Just gonna wait. And lastly, dividends are not tax deductible for whatever reason. Interest is tax deductible, dividends are not. So all else equal, I would rather have debt because of the tax deductibility of interest. Also, let's make a note here. If a company uses its cash on hand to financing investment, let's consider that an equity investment, because that cash is really owned by its shareholders. It's the shareholders, that is their right. That is their asset, right? So I'm going to consider a cash investment an equity investment because that could have been paid as a dividend. Let's talk about debt. What are the advantages of debt? The main one is the interest tax shield. When I pay interest, I get to reduce my tax bill. Another one, it encourages discipline by management. As a shareholder, maybe I wish the company has a little bit of debt to make those managers focus a little bit more and be a little bit sharper. Also, using debt doesn't dilute the ownership, and using debt can make the firm expand its operations. So think about if you only restrict yourself to equity financing, for the same level of equity financing, if you could use debt, maybe you could double the size of your business by using debt. And as long as we don't go bankrupt, I could double my net income and I could become richer as the owner. So the idea is debt could be used to expand the business, open, say, more stores, if it's a retail business, for the same level of equity. Disadvantage of debt: you have lower net income due to interest expense. You have that loss of future debt capacity and flexibility later. And then the last one is you have the risk of bankruptcy, right? It's a truism that is often overlooked. You cannot go bankrupt if you have no debt. So, through the COVID experience, pandemic of 2020, you realize that the huge advantages of firms that have zero debt. Right? If you can just shut down your operations, you no longer have expenses. You may have some rent or something due, but you no longer have interest expense and bank loans you're going to default on. So I think there's going to be a heightened appreciation for clean balance sheets. What we mean by clean balance sheets are lower amounts of debt on balance sheets to handle these future crises. So let's get back to the concept of optimal capital structure. So what does that mean? So say a firm currently has 0 DDE ratio and has this current WACC. And since there's the 0 DDE means there's no debt, so the current WACC is their CAPM cost of equity. And then if the firm issues a little bit of debt, and it's a really safe firm, it's a firm that doesn't really have that much business risk, you would think by issuing a little bit of debt and taking advantage of the tax deductibility of interest, you'd probably lower your weighted average cost of capital and increase the value of your firm. And however, you're going to only get so far, because at some point, the tax advantages of tax deductibility of interest are going to start to be outweighed by the risk of future bankruptcy or distress, especially thinking about pandemics now. And so there must be a sweet spot, the optimal DDE ratio that trades off this distress cost of debt and the tax deductibility of interest. And that's what we call the optimal WACC, and that's where the firm value would be optimized. So in theory, a little bit of debt's probably good to increase the value of the firm, but we don't really know exactly where that sweet spot is. And in current environments like a pandemic, maybe the 0 debt is the optimal solution. So, but here's something a little bit depressing. When I look at empirical evidence, firms that have more debt, do they tend to have higher market values? Say higher PE ratios relative to other firms. There's little empirical evidence that actually DD ratios affect WACC and firm valuation. So that's kind of depressing. Our theory says that there should be an optimal amount of DDE ratio, but actually when we look at cross-section of firms, actually DDE ratio seems to have no impact on WACC and value of a firm. Well, let's think about the implication of that. When we look at firms, DDE ratio doesn't seem to affect WACC. So this allows us to possibly use a shortcut to calculate WACC for a company. If the DDE ratio doesn't matter, why don't we just assume it's 0? So if the DDE ratio doesn't matter, just assume 0, and instead of calculating the full WACC, I'll just calculate the CAPM cost of equity using an unlevered beta. So if Walmart wants to open up another store, just assume no debt, use the risk-free rate plus the unlevered beta for Walmart times my market risk premium, and I'll just use that. And if they want to open up a bank, I'll just use the banking unlevered beta. And if they want to use different DD ratios, well, that doesn't matter. Let's just assume it has 0 debt and use the unlevered beta again. So this is an interesting finding that capital structure doesn't seem to affect WACC and valuation. So one last thing I want to talk about, I'll talk about summary here. I already talked about all this, and this is how you could unlever and relever betas and to get to new cost of debt or cost of equity and calculate WACC. I'm just going to add one thing to that little table, and that is another way of calculating WACC is just take an unlevered project beta and plug it into CAPM if you believe that capital structure doesn't matter. Now in reality, I'll probably do a couple of these methods and try to look at them and compare them and try to come up with a reasonable WACC for my project. So that is section number 6.